Mr. Ashok Tyagi, Whole-Time Director with DLF. Mr. Tyagi, always a pleasure to have you on ET Now. Thank you for joining us. Now, there is data which seems to be indicating that this time around the Diwali and Dussehra season for Indian real estate companies has been a rather lukewarm one. Mamla thanda tha. Is that been your experience at DLF?
So at least, frankly, in the ticket sizes that we sell, honestly, Diwali and Dussehra have never quite been been like huge sales concentration points, because at least it's been my, stand that buying a house is a decision far more serious than buying a pressure cooker on Dhanteras. So really, yes, Q3 and Q4 typically, traditionally are the stronger sales quarters. Obviously not in the last 2 years, though those 2 years were extraordinary years. But this year we have seen, some degree of sales traction almost right from January, Nikunj. And honestly, that sales traction continues. We haven't seen, in all fairness, either an acceleration or a deceleration around the Dussehra Diwali time.
And this point slightly more. When I look at Mumbai real estate builders, the Piramals and the Lodas, the feeler which we are getting from them is that the volumes are only picking up when they are reducing the size of the flat, which means that if they wanted to sell a 2 BHK or a 2.5 BHK, they have made it smaller and sales have gone higher. So what is your experience at DLF? Do you think you are also looking at reorienting your product portfolio, and do you think volumes will come back the minute you start reducing the ticket size?
So if you look at our sales in the last 9 months, which the details of which were there in the analyst presentation also, you'd actually see that I think ballpark about 2/3 of our sales continue to come from the golf course road area, which is big and very big ticket sizes. So I think, while sort of from a gut level, what you are saying is makes sense. But the fact is, there are customers with well-to-do customers with the lines of financing tied up, who are today, frankly, if you ask me today, the biggest piece that is driving sales and differentiating products which are selling from products which are not selling is the ready availability of the apartments. So today, nobody is honestly willing to trust just a product which is on the drawing board or which is in the very, very initial stages of construction. But products which are complete or nearing completion are the ones gaining traction. And frankly, from our standpoint, since most of our products are in the complete zone, frankly, we have sort of, seen across the board secular bounce back of sales, and bounce back may be a strong word, but a recovery of sales. But a large chunk of it is still in the big ticket sizes on the golf course road. So intuitively what you say is right, but our data, frankly, is exactly in the opposite direction.
Okay, what about Mr. Tyagi, with regards to the funding needs for real estate businesses? How are you mapping the trend there? Because the very obvious question with regards to meeting the funding requirements is the rising cost of capital. How do real estate companies such as yourself deal with that environment? You already are aware of what's happening with the NBFC space. How does this extend out, and how does and I know that DLF, should be given credit that as a business, you worked very hard at kind of leaning out the business and selling off non-core assets. But what is the way forward in terms of keeping and maintaining your liquidity levels?
Okay, so in all fairness, I'll give this answer in a slightly more detailed manner if I can. What's clearly the case is that for the bigger developers, hopefully the bank lines would continue to be available, especially on the lease rental. Discounting is a product which continues to attract decent debt levels, and as does construction finance for the bigger developers. However, having said that, clearly the cost of raising funds has increased in the last quarter, I'd say, in the last quarter, by anywhere between 25 to 50 basis points, depending on lender to lender. However, the problem where I think which the industry is going to face with this NBFC issue is the access to funding of the relatively mid-sized developers who might not necessarily have lines of credit from the bigger banks or the bigger institutions. A large chunk of those, as we know, used to rely on the NBFCs and the HFC market. And frankly, for a variety of reasons, in the last 6 to 8 weeks, that sector has been under stress. And if that stress is not sort of mitigated for, say, the next couple of months, then I think some of those players could come under severe stress. The stress could be twofold. One is the developers' access to funding. B is a large chunk of the smaller buyers who used to access funding from the HFCs or the smaller NBFCs. They could face dispersal challenges. The bigger developers and in that sense the more well-to-do buyers will continue to have access to the bigger banks and the bigger NBFCs, and I don't think they would be under stress, except that the cost of borrowing even for them could rise slightly.
You broadly tell us about the NBFC route via which your buyers currently are buying. What we're trying to understand, Mr. Tyagi, is that there is a belief in the market that NBFC funding will get hard. NBFCs were funding a lot of home buyers or first-time buyers. Will that be an issue? Will that be a challenge?
So again, I think, frankly, while I'm no expert on the NBFC market, I think the bigger players are already, you're already seeing the difference between the way the bigger players are reacting and the bigger players' disbursals are going versus the relatively more stressed players. Frankly, we believe that at least from our buyer segment, most of our buyers typically used to go to the bigger banks or the bigger NBFCs. There was a small segment which was in the other HFCs and NBFCs also, which may or may not get impacted. But I think the overwhelming chunk of customers who were borrowing from the bigger, from the SBIs, the ICICIs, the HDFC Limiteds, I don't think their disbursal schedules would necessarily get impacted. Their cost of borrowing could, frankly, depending on how home loan rates tend to harden if they do. But I don't think their accessibility to funds will. However, players who were clearly, borrowing from the next rung NBFCs, I think, in some stage, if this entire NBFC liquidity issue is not resolved satisfactorily, I think in a couple of months one could see some degree of distress on the accessibility to funds of the relatively smaller borrowers with the smaller NBFCs.
Okay, Mr. Tyagi, I'll take the liberty of just moving away from demand trends and talk about DLF. Now, I must congratulate the management of DLF, because the way you've reduced your debt in this kind of a market, I guess markets are really liking it. You've got large sovereign funds who are also backing you now. So in terms of the debt issue, in terms of funding line, those issues have been sorted out. But what we need to also understand and get a sense from you is that what happens to the plan of right issue? We heard about that plan about a year ago. So is the decline in stock pricing really forcing you to reconsider that option?
No. So clearly, as you know, we had that huge GIC inflow, as you know, in December last year, which to a large degree has alleviated the debt issue completely. However, as a part of the downstream steps of that, A, there's going to be a residual inflow from the promoters, and B, there is going to be a, some form of an institutional offering, possibly a QIP. Both of those are pieces that we are working on. I don't think it's to do with the share price, but frankly, I think today the markets for the last few weeks have been volatile, and we are just sort of waiting for the volatility to slightly settle down before we move forward on those pieces. But those two are firmly on the radar and should happen.
Could you give us a timeline though, Mr. Tyagi, as to exactly when would the QIP commence?
No, obviously I can't give you a timeline to it, frankly, because apart from everything else, I'll also be violating disclosure norms. But when I say shortly, I'm honestly talking, frankly, in the not too distant future. So this is not something which we are going to do a year later. This is going to happen, in the next few months for sure.
So this quarter itself, basically, right?
This quarter, there's not much time left now. There's barely, a month left. But clearly, yeah.
No pun intended, sir. Let me define the definition of short. Buffett says that short term for him is 10 years. A trader would say short term for him is 15 minutes. So depending on what your definition of short is.
Okay, so I'd say within the next 2 quarters, definitely.
I didn't want to put you in a spot of bother, but we are television commentators. We try to just maximize when we get a big guest like you on the show. But if I have to, let's say, look at the...
No. So hence I'm telling you very, very candidly, definitely within the next 2 quarters.
Okay, wonderful. Thank you for that. I also wanted to get a sense of what is happening in the commercial market. The commercial market trends are slightly mixed if I look at the all India pattern, so to speak. Gurgaon and Mumbai trends are different, Chennai and Bangalore trends are different. What is your understanding of the commercial market?
So actually commercial, we in all fairness are actually even more bullish. So we are seeing, we are right now developing 2 big properties, one in Gurgaon and one actually in Chennai. And we have seen significantly strong pre-leasing trends in both of those properties. We are also frankly seeing, a consistent uptick on the rentals and the offtake. So the commercial leasing in offices is very strong. On the retail piece, we haven't got a new property since the Chanakya, early part of last year. And most of our rental malls run in the 90% plus occupancy piece. And again, there we are seeing strong trends in the revenue share and in the overall rental uptake. Obviously, there's some degree of churn in shops that always keeps on happening, which is a part of the entire animal. So I think the commercial leasing spaces, at least in the geographies that we operate in, which is predominantly NCR, but also Chennai and Hyderabad, we continue to see strong trends. We are building out the next asset in Gurgaon. We are building out the next asset in Chennai. We are planning the asset generation after this. So I think commercial leasing, which is all done in partnership with our partners GIC, is something that we are strongly focused on, and I think our leasing portfolio continues to be strong, honestly. And there we are continuing to see strong uptake in rentals and pre-leasing both.
Okay, Mr. Tyagi, great to have you on the show and really, get in a precise 360-degree perspective of what's really happening with real estate and, of course, DLF as well.